Hi there. Today, we're diving into the world of market makers, who they are and what role they play in the financial markets. This video is for anyone who wants to better understand how exchanges really work, where liquidity comes from, and who's actually on the other side of your trade. You'll find out who's working behind the scenes, why they're doing it, and how they profit every time you hit that buy or sell button. Stick around until the end so you can learn how to avoid the traps set by market makers and keep your money safe from subtle manipulation. Don't forget to like and subscribe to support the channel. Think of the stock exchange like a giant open market. There's always someone buying and someone selling. But what if you want to sell your shares and no one's buying? Or the other way around, you're ready to buy, but there are no sellers. That's where the market maker steps in. A market maker is usually a big investment bank or a specialized trading firm that agrees to constantly provide buy and sell prices for certain securities. Their job is to provide liquidity, which basically means making sure you can trade anytime you want. In a way, they're like a universal counterparty, always ready to buy from you or sell to you. Picture a currency exchange at the airport. You can always swap your cash, but the rate isn't exactly great. So why would someone take on that role voluntarily? Why would anyone be the market's safety net? Let's break it down. If you've ever looked at a level 2 quote or an order book, you probably noticed something. The bid price is always a little lower than the ask price. That difference is called the spread, and that's where market makers make money. They buy low and sell high, over and over again throughout the day. Take a stock trading at $100. A market maker might bid $99.80 and offer to sell at $100.20. If someone's in a hurry to sell, the market maker buys at $99.80. If someone's eager to buy, they sell at $120. That 40-cent spread is their potential profit. Multiply that by thousands or even millions of trades a day, and you get a serious payday. But this isn't free money. It's a game of speed. Milliseconds and algorithms that react faster than you can blink. And this is where things start to get interesting. Join our Telegram channel. That's where we post updates on new videos and articles. You'll find the link in the description or in the top comment. The more liquid an asset is, the easier it is for the market maker. More buyers and sellers mean more trades and less risk. But with illiquid assets, where trades are rare, it's a whole different story. Spreads can be wider, not 10 or 20 cents, but a few full percentage points. It's like paying a toll just to make a trade happen. And if the price of an asset suddenly drops, say because of bad earnings or a market panic, the market maker is the first one in the line of fire. Everyone rushes to sell and they're obligated to buy. If the selling pressure is too intense, they might end up with losses. In extreme cases, they even pull out of the market, stop quoting prices, because the situation is just too risky. And when that happens, liquidity vanishes like water in the desert. Funny enough, it's in those moments that market makers become even more important. Without them, trading might stop altogether. If you're buying 10 shares, no big deal. But imagine a fund that wants to buy 100,000 or even 1,000,000 shares. Without a market maker, that kind of order could tear the market apart. The price would skyrocket, and it might take hours or even days to complete. A market maker, with their inventory and capital, acts like a buffer. They can take on the entire order or break it into parts without causing wild price swings. That's especially useful for big institutional players who need to move large volumes without drawing attention. But even for everyday investors, like you and me, market makers are essential. They let us make trades quickly at a predictable price and without needing to hunt down someone to take the other side. Even though market makers are helpful, they're often accused of manipulating the market. And to be fair, sometimes that suspicion isn't unfounded. They've got resources, access to real-time info, and blazing speed. They can influence price movements by placing massive orders that either scare or excite the crowd. It's a strategy. Place a huge buy order to make it look like there's demand. then cancel it once retail traders jump in. This tactic is known as spoofing. There's also fake breakouts, stop-loss hunting, all kinds of tricks market makers can use, and sometimes they do. Take the whole GameStop saga. Citadel, a major market maker, was accused of pressuring the Robinhood app to limit purchases. That led to all kinds of conspiracy theories. And while no guilt was proven, trust in the system definitely took a hit. Today's markets are very different from 30 years ago. These days, brokers can sell their clients' order flow to market makers for money. It's called payment for order flow. Here's how it works. You send an order, your broker doesn't route it to the exchange, but to a market maker. They fill the order and pay your broker a fee. That's how commission-free brokers like Robinhood operate. But there's a catch. The market maker is paying for the right to be your counterparty. That means they're incentivized to fill your order at a price that works for them, not necessarily the best one for you. So your broker isn't focused on getting you the best price. They're focused on getting paid. That's a clear conflict of interest. Some countries have banned this practice, like the UK, Canada, and Australia. But in the US, it's still perfectly legal. Millions of investors are part of this system without even realizing it. If you've ever traded low-volume stocks, you've probably seen spreads that aren't just a few cents, but tens of dollars. That's not because market makers are greedy. It's because the risk is high. With fewer participants and sudden price swings, market makers have to price in uncertainty. They don't know if they'll be able to offload the asset quickly or if they're about to get caught in a price collapse. In high-volume stocks, spreads are razor thin, sometimes just 1 cent for big-name companies. But for more volatile or obscure stocks, spreads can stretch to 1 or 2%. That's important to understand, especially if you're using market orders. You're always giving up part of your potential profit in exchange for speed. So, can you avoid market makers altogether? Well, not really. They're active in nearly all liquid markets: stocks, bonds, currencies, futures. Even if you only use limit orders and never trade directly with one, they still shape your environment. They set spreads, create liquidity, and affect how fast your orders get filled. That said, if you're a long-term investor, buying and holding for years, their influence is minimal. You don't care about spreads or short-term volatility. For investors like that, market makers are more like a helpful utility than an opponent. But if you're trading actively, and especially intraday, you're playing against professionals who are faster, smarter, and better equipped. Speed is a huge advantage for market makers today. Their algorithms act in milliseconds, scanning markets and adjusting quotes instantly. That's how they profit from tiny spreads, by doing it hundreds of thousands of times per day. We're not talking about someone with a calculator here. This is full-on data center stuff. These servers sit as close as possible to the exchange to reduce lag. The closer they are, the faster the trade. This approach is called high-frequency trading. It's not just faster than humans, it's a different game entirely. The competition isn't between traders, it's between machines, lines of code, and data transmission speeds. In this world, the fastest wins, not the smartest. Still, market makers aren't just robots. There's a team behind them: coders, analysts, risk managers. Because even with speed, markets are unpredictable. When unexpected events hit, like exchange outages, bankruptcies, or geopolitical shocks, the algorithms can choke. That's when humans step in. They make decisions, pull back, tweak the models, reduce risk. It's a reminder that behind every soulless script, there's a living, breathing team. One important point: market makers aren't trying to win every tick. Their goal isn't to predict where the market's going, it's to stay balanced. They don't bet on up or down, they aim to stay neutral. If they've bought too much stock, they look to sell. If they've sold too much, they try to buy back. What matters is keeping their average price in line with the market. But sometimes they're forced to hold a position, long or short, for a while. Then, they become real players, taking on risk. If the market moves against them, they might try to steer things back in their favor. That's when manipulation can happen. Manipulation is the dark side of market making. It's illegal, but hard to prove. Take spoofing, for example. Placing a huge order with no intention to fill it, just to trick others. The price approaches, the order disappears. But the crowd is already in, and the market maker flips the script. We just published a new article on our website. You'll find tons of free content on stocks, bonds, and ETFs, whether you're a beginner or looking to level up. Check it out and bookmark the page. Another move is stop hunting. If they know most traders have their stop losses at a certain level, they might push the price down there, just long enough to trigger those stops. Panic selling begins, and the market maker scoops up shares at a discount. These tricks are hard to detect because they blend into the noise, but they're real, and savvy traders learn to spot them. Market makers also use the news. You'll really notice this during earnings season. Strong results can come with price drops, weak ones with a spike. Why? Because the news was already priced in. Market makers might sell before the news, buy on the dip, or the other way around. That's why news trading is dangerous. While you're reading the numbers, they've already closed the trade. For long-term investors, all of this is background noise. They're in it for the years, not the minutes. But for traders, every move is an opportunity or a trap. Understanding how market makers think helps you avoid those traps and trade smarter. And here's the thing. Market makers aren't villains. They're not out to get you. They're working within the system, making money on the spread, managing risk, and keeping the market liquid. Without them, trading would be slow, expensive, and chaotic. Their presence is the price we pay for fast, seamless execution. Sure, they've got more info. Sure, they're faster. But you've got the power of choice. You don't have to chase short-term profits. You don't have to buy the hype. You don't have to place stops in obvious spots. You can invest wisely, knowing how the market works. And that, right there, gives you the edge. So here's a simple tip. If you don't want to play the market maker's game, don't play it. Build a long-term strategy instead. That way, the market maker becomes your silent ally, always ready to buy from you or sell to you at a fair price. Smash that like button and subscribe. If you want to support our work, check out the membership link in the description or the pinned comment.